Welcome to this technical deep dive. Today, we are addressing a critical decision for UK micro-entities and small businesses, the choice of accounting standard. Specifically, we are looking at FRS 102 Section 1A versus FRS 105. Many business owners treat this as a simple compliance box-ticking exercise at year-end. But as we'll see today, the framework you choose can fundamentally change how your business is valued by lenders, investors, and even how you plan your dividends. Let's start with the executive summary. The core conflict here is simplicity versus strategy. For UK micro-entities, the temptation is always to choose the simplest route to minimize administrative costs. However, the simplest route, FRS 105, often hides the true value of your company. If your roadmap includes refinancing property, seeking external investment, or exiting the business, the accounting standard you choose today will dictate the strength of your balance sheet tomorrow. First, let's establish if you actually have a choice. Under the Companies Act 2006, you qualify as a micro-entity if you meet two of these three criteria: turnover under £632,000, balance sheet total under £316,000, and 10 or fewer employees. If you meet these, you can use FRS 105. But the key word is optional. Just because you qualify for the micro-entity regime doesn't mean it is the best commercial decision for your specific set of circumstances. Let's look at FRS 105. We call this the Simplicity Doctrine. The major advantage here is privacy and ease. The accounts are presumed to give a, quote, true and fair view by law, and you file very minimal data at Companies House. However, there is a massive commercial downside: no revaluation. Under FRS 105, assets must be held at cost. If you bought a commercial property 10 years ago for £200,000 and it's now worth £500,000, FRS 105 forces you to show it at £200,000, less depreciation. You are effectively hiding your own net worth. This, quote, black box approach can be a red flag for lenders. Now compare that to FRS 102 Section 1A. We call this the Transparency Doctrine. This standard requires a true and fair view. It allows for fair value accounting, meaning you can revalue that same property to its current market rate. This immediately boosts your balance sheet, improves your loan-to-value ratios, and can unlock better borrowing rates. The trade-off? You must recognize deferred tax on those gains, and the disclosures required in the footnotes are much more detailed. But for a growing business, that transparency is often an asset, not a liability. Visualizing this trade-off helps clarify the decision. As you can see on the chart, FRS 105, the cyan bar, keeps compliance costs low, but lender visibility is almost zero. It is opaque. FRS 102.1a, the dark blue bar, pushes compliance costs up slightly due to the extra disclosure work, but lender visibility skyrockets. Banks prefer this standard because it shows them what the business is actually worth today, not what it cost 10 years ago. So what is the verdict? Choose FRS 105 if you run a straightforward consulting or service business, have no significant assets, and your priority is simply minimizing your accountancy bill and keeping data off the public record. Choose FRS 102 Section 1A if you are a property holding company, or if you intend to seek bank lending or external investment. The ability to revalue assets is often critical for these businesses. A warning: switching between these frameworks is a complex accounting process involving transition adjustments. It is a strategic move, so plan it carefully with your advisor. We hope this technical deep dive has provided clarity on the requirements and the strategy behind UK GAAP. Every company's situation has unique complexities. If you are unsure which framework best supports your commercial objectives, specifically regarding property portfolios or dividend planning, please get in touch with the team. Thank you for watching.